So my first monthly dividend income was $1.62 in October of 2021. If you told me then that in less than 5 years, I could expect to receive $250 per week in dividend income, I would have questioned your sanity. But today I'll share with you 8 stocks in my portfolio plus 1 ETF that are soon going to start paying me $250 per week. I am a passionate dividend investor, and if you've watched any of my prior videos, you'll know that. I love dividend income because I'm looking to build another stream of income that will allow me to quit my day job and get to financial freedom. So most of the stocks that I hold are dividend stocks. I probably just have 1 stock in my portfolio that does not pay dividends, and I have about 21 stocks in my portfolio. I will also share with you how many of each of these stocks you need to hold in order to achieve this goal of collecting $250 in passive income per week. Now, as always, please note, this is not financial advice. You need to do your own research before you invest in any stocks. Now, for those who may be new to dividend investing, a dividend is simply a type of passive income. It is a company sharing part of its net income with its shareholders. So if you invest in the shares of a publicly listed company, then you are a shareholder of that company. Now, something to note is that not all companies pay dividends. The other thing is that dividends are not guaranteed. So if you're looking to invest in dividend stocks, you need to do your research to determine the dividend stability and sustainability of any company. I typically invest in blue chip stocks of large, well-established companies that have been paying dividends forever. Think Johnson & Johnson, Procter & Gamble, AbbVie, or the big 5 banks in Canada that have been paying dividends for decades. The other thing to keep in mind is that high dividend payments by a company may be a sign of declining stock prices. So do not go after a company because you're seeking to collect higher dividend payments, because that may be a risky company, typically known as a dividend trap. So be very careful in selecting what companies you invest in, even if you're seeking dividend income. So now on to the stocks. The first stock is Procter & Gamble, ticker symbol PG. PG is a household name, and most of us use its products on a daily basis. Think Tide, Bounce, Oral-B, Bounty, Pampers, Crest. If you look around your house, chances are you will have a product of Procter & Gamble somewhere around your house. It is a staple in most dividend portfolios. Even Warren Buffett has Procter & Gamble in his portfolio. It is a dividend king, meaning that it has consistently increased its dividend payments for at least 50 years straight. In fact, Procter & Gamble has consistently increased its dividend payments for 68 years. So P&G is a dependable and stable dividend payer. P&G has a market cap of about $410 billion, and it's currently trading for about $174, which is still below its 52-week high of $180. And it's still below analysts' average target price of $178. However, it's starting to creep up and get a bit expensive. But if you're looking to invest in the stock for the long term, then today is as good a time to invest in this stock. It currently has a forward yield of 2.31%, and it pays a dividend of $4.03 per share. So if you invest in 250 shares of P&G, you will receive $1,007.50 annually in dividend income. P&G has a payout ratio of 63%, which is very good. The general rule of thumb is that a payout ratio of 60% or less is very good. However, that can be relative depending on the sector and the industry. So a payout ratio is basically the percentage of a company's net income and cash reserve that it pays out to investors or its shareholders in the form of dividends. A low payout ratio means that the company still has room to keep on growing its dividend payments. It shows the sustainability of dividend payments by a company. Simply Safe Dividends rates P&G's dividends as very safe. The second stock is the Royal Bank of Canada, RBC, ticker symbol RY. RBC is one of the big 5, a group of 5 big banks that dominate the banking sector in Canada. In fact, RBC is Canada's largest company by market capitalization. RBC is a very profitable company with operations in 29 countries, including expansions and growing operations in the US. It has a market cap of $230 billion, and the stock is trading at about $165, which is significantly below its 52-week high of about $181. It's also trading below analysts' average target price of about $185, so now might be a good time to buy. The stock has a yield of 3.56%, and it pays a dividend of $5.92 per share. If you invested in 300 shares of RBC, you'd collect $1,776 in dividend income annually from this stock. It has a great payout ratio. Its current payout ratio is 46.38%, which means that it has significant room to keep on growing its dividends at a good rate. RBC's dividends are considered to be very safe. Now, if you enjoy content like this, please consider liking this video and subscribing to my channel. It encourages me to continue making these videos. Let's move on. The third stock is AbbVie. AbbVie is a pharmaceutical and biotech company and is well known for the manufacture of autoimmune and cancer drugs like Humira, Skyrizi, Rinvoq. The stock is up nearly 20% year to date. It previously fell to about $165 in the fall in November last year, largely because one of its drugs had failed its second stage trials. Since then, it has recovered beautifully and it's currently trading at about $212 per share. AbbVie is another blue chip stock in my portfolio with a large market cap of about $370 billion. And as I indicated, the stock is currently trading at about $212 per share, which is still below its 52-week high of $215 per share, but it's starting to get a bit expensive. The stock has a nice forward yield of 3.10%, and it pays a generous dividend of $6.56 per share annually. Because of the generous dividends, if you invested in 300 shares of AbbVie, you'll receive about $2,815 in dividend income annually. Now, to clarify something, I hold my stocks both in Canadian and US dollars because my platform allows investors to do so. However, the amounts I am sharing with you are in Canadian dollars. I will, however, provide the US dollar amounts for all US dollar listed stocks. AbbVie, Procter & Gamble, those are some of my US dollar listed stocks, and I will provide the US amounts for all US listed stocks. Now, unlike the first two stocks, AbbVie has a very high payout ratio of 260% and may be considered risky due to the high payout ratio. Now, a payout ratio of over 100% means that a company is borrowing in order to continue paying its dividends because that's more than its income. Its total income would be 100%. Usually, companies that have built a reputation for paying steady dividends or increasing dividends do not want to break their streak. So sometimes they will borrow to continue honoring dividend growth and keeping their investors or shareholders happy. That's why it's important that you do your research to understand the fundamentals of a company before you invest in it. I am happy with investing in AbbVie, even with a payout ratio of 260%. According to Simply Safe Dividends, they rate AbbVie's dividends safe. The fourth stock is Johnson & Johnson, ticker symbol J&J. J&J is another household name and we all use its products. Think of off-the-counter medication like Tylenol, Motrin, Band-Aid, and so on. It is also a dividend king, meaning that it has consistently increased its dividends for over 50 years. In fact, J&J has increased its dividends consistently for over 60 years. It's a large cap stock, a well-established, dependable company, and has a market cap of over $400 billion at the time of this recording. J&J is currently trading at about $165 per share and has a nice yield of about 3%. It pays a dividend of $4.96 per share annually. If you invested in 250 shares of J&J, you'd collect about $1,774 annually in dividend income. It has a decent payout ratio of about 84.5%, Yes, it's starting to creep a bit up, but according to Simply Safe Dividends, J&J has very safe dividend rating. The fifth stock is TD Bank, ticker symbol TD. TD is one of Canada's big five. It was founded in the 1800s, and although the stock was beaten down a lot over the past 3 years, it has started to recover this year after 3 years of underperforming the market because of troubles it had with US authorities regarding a money laundering scandal it had in the US. Year to date, it's up almost 12%. TD is also a large cap stock with a market capitalization of about $150 billion. At the time of this video, the stock is trading at about $85, which is below analysts' average target price of about $90. It's also below its all-time high of about $109, which it reached in 2022. The stock has a nice forward yield of 4.96% and pays $4.20 in dividends per share annually. So if you invested in 300 shares of TD, you'd collect about $1,260 annually in dividend income. I own about 230 shares of this stock, and I am working towards getting to this target of 300 shares. It currently has a payout ratio of about 87%, which is an improvement from a few months ago when it had a payout ratio of 93%. Again, TD is just recovering from 3 years of the share being beaten down due to troubles it was having with US authorities. It finally settled by paying a fine of about $3 billion in the fall of 2024. From here on, I think it's upwards and onwards. We'll see. The fifth stock is Coca-Cola, ticker symbol KO, another blue chip stock and a dividend king. Coca-Cola is the world's largest beverage maker, and more than 2.2 billion servings of its beverage are consumed around the world every day. It is a staple in many dividend portfolios and is up 23% over the last year, and year to date, it's up about 15%. It has a market cap of about $300 billion, and the stock is currently trading at about $71 per share. It has a good yield of 2.9% and pays a dividend of $2.04 per share. If you invested in 250 shares of Coca-Cola, you'd collect about $730 in dividend income per year. It has a payout ratio of about 79%. Yes, it's starting to creep up there, but I'm comfortable investing in and holding Coca-Cola. I think the dividends are pretty safe. According to Simply Safe Dividends, Coca-Cola's dividends are safe. The sixth dividend stock is Enbridge. Enbridge is an infrastructure company with major pipelines for liquids and gases in both Canada and the US, and it is also a staple in very many dividend portfolios. Because Enbridge operates in a regulated industry, it's a great defensive stock with a reliable and growing dividend. Enbridge operates in multiple segments, including hydro, solar, and wind elements, and it operates the largest natural gas utility in North America, serving nearly 7 million people. Enbridge is another large cap stock in my portfolio with a market cap of about $132 billion. At the time of this video, the stock is trading at about $60 per share, and it offers a great forward yield of 6.33%, pays $3.77 per share in annual dividends. If you invested in 350 shares of Enbridge, you'd receive $1,320 in annual dividend income. Enbridge has a rather high payout ratio of more than 155%, and so would be considered rather risky. However, I'm not concerned about that because I know that the company has a lot of long-term contracts both in Canada and the US, and so it will continue to have steady cash flow or revenues to continue paying its dividends. This is where you need to do your own research, understand the company before you invest in it. So last but not least is Bank of Montreal, ticker symbol BMO. Bank of Montreal provides financial services predominantly in North America. It's another of Canada's big five. So you can see that I own 3 of Canada's big 5 simply because they are great dividend payers. All of Canada's big 5 banks were founded in the 1800s and they have stood the test of time. They've survived through recessions and depressions and continue to pay good dividends. Bank of Montreal has been paying dividends for about 2 centuries. It has a nice and growing dividend. The stock currently has a market cap of about $100 billion, and the stock is currently trading at about $142 per share, which is below analysts' average target price of about $154. The stock returned about 19% over the last year, while the index, the TSX, returned about 15%. It currently has a nice yield of 4.53% and pays a very generous dividend of $6.36 per share annually. If you invested in 300 shares of BMO, you would receive $1,908 in annual dividend income. Really generous. The stock has a great payout ratio of less than 60%, about 58%, which means that it has room to continue growing its dividend payments. What every dividend investor is looking for: dividend sustainability and stability. Overall, BMO has a safe dividend. Last but not least, the one and only ETF to add to this list is SCHD, a popular Schwab dividend ETF, exchange traded fund. The ETF underwent a 3-for-1 stock split in October of 2024. It previously was trading at about $85 per share. It currently trades at about $28 per share. The ETF has a really low expense ratio of 0.06%, which means that it will cost you about 60 cents for every $1,000 you invest in it. One of the reasons I like SCHD is that not only is it a great dividend ETF, it's one of the few ETFs that's not dominated by the tech sector. The top 3 sectors are financial services, healthcare, and consumer staples, sectors that are stable and dependable dividend payers. Based on current TTM yield, the ETF pays about $1.08 per share. So if you invested in 500 shares of SCHD, you'd be able to collect about $540 in dividends per year. So based on those 8 individual stocks plus 1 ETF, you can see that you should be able to receive $13,020 in annual dividend income, which is equivalent to $1,085 in monthly dividend income. And that's also equivalent to $250.40 in weekly dividend income. So anyway, that is part of my portfolio that I'm focused on building in order to receive a steady dividend income of $250 per week going forward. I will continue to provide updates on this channel, so be sure to come back and watch more videos. I hope you enjoyed the video and found it helpful. If you did, please consider liking and subscribing. Thank you for watching.